Hello, Warriors. Who's ready for the second game of the doubleheader on inflation today? Are you AJ? Arthemio, welcome to F.A.C.E. New name to me, Sinatra, Brand, Michael Wiseman, Michael Bergman. Richard, how are you? Spazo, and interesting position the markets are in, team.
I'm going to do a Blake, Dale. Before you even start, I want to know where your offer is in the euro dollar around 112 so I can park in front of it.
Okay, we'll see. You know, it's not only the price, it's how it gets there. And, you know, even if it gets there, it's going to have to do some distribution because of all the mo, right? So, you know, there's that, you know, been looking for a panic under, you know, par on the dollar for weeks. Fortunately, stayed long silver from 22.40. I'm looking for 25. I've been talking about that, 25. I have some gold shares. The S&Ps are another story. Yesterday didn't get a 3 drive. It still has a form, but, you know, something I want to say about the 3 drives, just because I may anticipate a candle, a reversal candle, and take a shot at that. You need red candles to confirm, you know, at least one red candle on the minimum of a 4-hour chart. And if you're playing a daily 3 drive, you need a red candle. So blow off continues there. So here's a question, Ryan. So, you know, if you have fresh money, does it feel late to, you know, get short the dollar? And does it feel early to try and get long? And what do you do?
You trust your levels. You trust your levels. That's the only thing we can do. The only thing we can do is trust our levels. You know, you look at dollar yen. If you take the wide,
38.
We had two levels that you look at: 145 on the way up and 138 on the way down.
Yeah,
that was it. 2 levels. And for now, 145's that speaks for itself. 138's had a little go, and we've held it for now. It's got to develop, but you know, that's why we look at we say pick your strongest levels. Don't try getting chopped up in the middle. Sit and wait, let the market do its thing. And if you get a period of price action that says we're not breaking this level, then you can do something at it.
Right. Okay. So that takes a lot of patience. You know, sitting in front of the screen, and that's, you know, Tom Petty. You guys knew Tom Petty over there, right?
Yeah.
One of his best songs was "Waiting is the Hardest Part."
And the weird thing is, I'm both sides of dollar yen now. I jumped into a short yesterday above 139, and you know, been talking about the 138, so I couldn't resist going long at 138.10. So
and you're going to sit there and brag to us that you get to play both sides of the market. That means you're always right.
To us,
I mean, you know, us here in North America, we don't get to do that crap. We don't have that liberty.
When are they going to take our handcuffs off, Blake? You
What's
fought
that?
for this. When they're going to take our handcuffs off, Blake? You
no
fought
shit.
for this country.
Seriously, we like really get.
I mean, you know,
screw the pooch over here.
What's the problem with doing what they're doing over there? Has it ruined their, you know, their economies or anything?
Dude, I don't know, man. I do envy you guys, and you know that's one of the things about.
Is this America, Blake?
Well, that's why you join the trader funding program, then you get to trade through.
What a great segue!
Yeah, as a U.S. trader, you can trade everywhere else, man. I tell you. But you know, it's funny when I passed my assessment early on. You know, just doing it for everybody. I didn't even use that ability, and because you forget, right? You forget how it works. But Ryan, you're on both sides of the yen.
Yeah, it's one of those trading a short term, you know, quick scalp versus picking up the big levels. You know, you can't talk about a level for so long and not ever go at it when you get near it.
Yeah. I mean, the 138 level, as you said, is really, really big. By the way, Dale, great pickup on silver. I talked about it on it was one of my setups last night on the trade off. The triangle actually points to 25.25.
Okay, that's where I was planning on getting out at 25. Because,
Yeah.
you know, I hate to disappoint a lot of precious metal bulls that are looking for this to be the squeeze. But I still think there's a dollar rally coming in the next, you know, it probably takes a few weeks to bottom, but I still think this could be a sell, and we revisit these lows, and gold actually doesn't even look as strong. I don't think we close over 2000 before we get another one of these, and you have a chance in the low 1800s to buy. So this was just a trade taking advantage of the last, I thought was going to be the last bout of extreme weakness in the dollar. And I could be wrong, and maybe the dollar is going to crash, but that's the way I'm looking at things.
Well, the dollar has fallen below 180, right? So that's a big breakdown.
Wait, are you broadcasting from Paros right now?
I am. Yes. Hello, everybody.
Oh my God! Seriously,
you what a junkie. He's on vacation and he's got to talk about.
I actually got
180.
I got stuck against my will on that stupid island, and I had to drink like pina colada drinks or whatever they put the damn umbrellas, and I actually had to sit on the beach and like just sit there for like 4 hours.
Terrible.
It was horrible. Like
he's been there. Stelios has been there 5 minutes, and he's been on the Flow Show. He's been on Face. Still, if you don't want to enjoy your holiday, mate, we'll swap. I'll go and sit on the beach, and you come back to the office.
I think everyone will take that deal, buddy.
Anyway, yeah, let's go.
So go ahead. Does the market look different from that island you're at?
The markets look the same. But the dollar has broken down. That's the main thing, and what remains now for me is yields. We've talked about 382. I've talked about 82 being making it a false breakout, and we are at 382 in the 10 years. So
and Tommy just mentioned that too, and it's back to the trend line, and that's the chart right there, Dale, that Stelios is referencing.
Yeah, exactly.
I know. I'm a mind chart reader.
And also remember what I said yesterday, if the data is weak, buy gold and silver wherever they're trading at market. Well, we had after the data came out, silver jumped from 23.20 to 350. It stayed there for 2 or 3 minutes. We all had a chance to get long there. But anyway, PPI could really put a spanner in the works if it comes in.
Did you do
hot. I was out, so I couldn't. I stayed out after that. So, But anyway, I've missed a lot of things. I missed Norway. I've missed everything, but it's okay. It's okay. It's part of life. But I tell you what, if PPI is strong today, then I don't know what's going to happen. But I have a fear that PPI is going to be another weak reading, and this move will continue.
Okay, now go in the water.
I came in today pretty short the dollar, and I already started taking a little bit off this morning ahead of the data. But the PPI, I mean, it's either going to make or break us today. I mean, and this dollar this is a bearish breakdown. I mean, I don't think there's any which way you can get around that. And Nuno was asking what the drawdown of 6% a day on a live TFP account means. You get suspended, right? And that's correct. I mean, look, the reason why we have an intraday drawdown actually, I believe it's less than that. It's 5%. Sorry. Yeah. Because look, if you, I mean, shit happens, there's situations where, the markets move aggressively, but if you're losing 5% in a live account, we have to cut you off. I mean, we're coughing up the losses there. And that tells us that you cannot control your intraday risk. And as a if you're managing our capital, that we would be out of capital if we allow for anything more than that. So,
and all these rules that we have there for better risk management, we have so many people giving us feedback saying, look, these rules actually help me be better and more controlled in what I do in my risk taking. So it's there for the trader's benefit.
Yeah.
I hear Nick Leeson just passed an assessment.
Hey, so what
wants to trade the Nikkei.
You know, can we have a conversation? Ryan and I have been having a discussion in the ForexAnalytix chat room about fib levels, and I want to go into this because Ryan doesn't know shit.
Charts,
I need to correct his ass here for a second.
Here's a little mentoring from Blake Morrow right here.
I'm just kidding, Ryan. I'm totally kidding.
I know.
You know, one of the I learned from some of the I would say some of the premier people to learn fibs from. Matter of fact, Forex.com actually used the gentleman's algorithm for many years back in the early 2000s. You know, and I spent 2 weeks with him, and you know, learning fibs. This is back when I used to actually have to draw Fibonacci's with protractors. I still have the protractors in my office here. You know, when we used to draw it on paper. So interesting. Ryan and I were talking about the difference between where I see the 618 retracement in the euro at 112.87, and he's like, well, I see it from here, and he uses this this level right here, right, which is, you know, we're coming into it, and you know, he goes, well, that's the difference of you and I using it from two different levels. You know, we had a 500 pip draw moved lower in the euro, then a bounce back, you know, and then the real move started from here. The way I've always learned fibs, and this is you take whatever chart you want. Take a 15-minute chart, take a 4-hour chart, take a daily chart that you see here, put it on a weekly chart. I don't care. Then when you look at that chart, blur your eyesight. And then once you blur your eyesight, take it from the very top or bottom of each peak and trough you see. That to me is the actual move. Like for, you know, looking at the euro dollar, just staring at right here, this is a move, right? To me, this is a move to me. This is a move to me, you know, and this is a move to me. Of course, there's little like these little smaller moves you're going to see maybe on a 4-hour chart that you see here. But if you do that and you make that a practice, a normal practice when you're drawing fibs, I think that'll help you a lot. Now, Ryan, one of the things I will say though is when you're looking at fibs and you're looking at, and this is not just to Ryan, this is to everybody. When you're looking at fibs, confluences are so important when you're trading. And so if I can draw fibs from different levels and get confluences, you know, falling on each other, that the you know, once you get 3 or 4 at the same level, it reinforces the idea that you might get some sort of reaction from that level as well. So I'm not opposed to drawing, you know, a fib here and a fib here, especially if I can draw a fib here from like you do and correspond it with maybe an intraday extension that I might find on an hourly chart or on a 4-hour chart. It might give me a little bit more confidence to that. But anyway, I just wanted to give you guys
key. You know, and that was a great lesson. Put it on tape. How to use fibs.
That's well, great. It will be. It actually is going to be recorded and put on our YouTube channel. So whether we like it or not, but that's just something. You know, just you know, that's the way I've learned over the years, and it's you know, that's I just wanted to you know talk about that a little bit.
It could take people years to figure that out without an experienced person who took the time to learn the correct way to do it and present it.
Yeah, and Ryan, feel free to expand on your thought on my thoughts there, or you know, anything.
Yeah, it's all a bit about context. You know, for me, it's a bit of a measuring thing up there. You know, a 600, 700 pip move down in that first instance,
right here,
in the size is quite a big chunk compared to what the price has done overall. You know, a 200 pip move, I'll be at the same level as you are. If it was a 200 pip down and up, you know, like you get half all the way down in the trend, you get pullbacks and whatnot. So it's just one of those judgment things. If I think that sort of move is too big for the overall trend, then I tend to take the pure thing. But, you know, if that was a yearly chart, a yearly price move, I probably wouldn't I'll probably place it where you are. But you know, tech. The thing with tech is it's all how we use it. It doesn't matter where your lines are, where my lines are. It's what you do with the trade at your line. You know, I could get a pen and draw a line on that on my screen right now and say, well, that's my technical level. If the price gets there, I'm going to buy it or sell it or do whatever. So, you know, every trader does what works for them, but it's how you trade the levels that matters.
You know, that's a great concept, and it's something that the way I like to explain that to people is, look, you know, if I gave you a hammer, and I'll take the exact same hammer, and we'll go up to the wall in our house, and here's a nail, here's a hammer. We got the exact same nails, we got the exact same hammers, but the way that I put that nail into the wall might be slightly different than the way you put that nail into the wall. Ultimately, the nail goes in the wall. Mine might be a little smoother or maybe a little bit more cockeyed than yours, but it's the way you're using that tool that was given to you. As long as you have consistent outputs with any tool that you're using, it's just the way you use the tool. It's the way you swing that hammer. And that's why there are so many. You know, when you're looking at technical analysis and you go into indicators, you can get lost and just in the weeds. You'll notice, and people that, like, you got Rick Reedy that's been with me literally for about 20 years. He knows my charts have looked exactly the same for as long as he's listened to me broadcast, almost 20 years. And same with Amir. Amir's been listening for probably better. About 18. But it comes down to how you use the tools that are on your screen. You'll notice that I don't use anything but RSI. And it's not because I think, oh, oscillators are shit. And, you know, I might put a Ichimoku cloud on there from time to time, but it's not like I consistently use them, and I don't use them because they're crap. No, that's not true. It's just, it's the way you're using the tools that are on your screen. I try to keep mine really simple. And I think if you keep your analysis fairly simple and you become consistent with the tools that you are presented with on your screen, then you're going to have consistent results because you're using consistent outputs on those instruments that you're using. Anyway, just my 2 cents. I hope that I hope that explains.
What are you talking about? They're pearls.
Yeah.
Anyway, $2 worth $1 million.
Yeah, well, I hope that all made sense to you guys. Let's discuss though today. So here's the euro, and speaking of something we can't dispute, if you look at the 127% extension of the last big move lower, that was the last time we had, you know, this range extension. You can actually go. You could say, well, Blake, don't we have it here? But we're past the 161% extension. So we have to go to a 261% extension, which takes us way the hell up here. The 127% extension of this move and this, you know, pattern, the harmonic pattern you see here, takes us towards 112.18. Really overbought intraday, but that's a level that could be tested today on weak PPI. If we have weak inflation data, we're going to be trading at 112.18. This is the one thing that's a little scary about, like, the sterling. You know, we were having this conversation yesterday, Ryan, and I'm looking at the sterling, or, you know, and going, damn, man, we're above 130. And, you know, how about if stops get triggered? I mean, a lot of people are trying to stand in the way of the cable up at these levels. And I understand the reason why. I mean,
any harmonic that would project a top like you had in euro?
You know, I mean,
and that was what, a Gartley that completes up there at about.
No, that would be more of a butterfly or a cipher, not a cipher. I'm not a snail. Harmonic, yeah, monkey. Might be a monkey pattern.
Bring Andre.
Anyway, yeah, we got to bring Andre up here. Anyway, I'm just looking at previous resistance, or previous support being, you know, a big pivot up here around 131. Yeah, 131.70 level. You know, you take the big fib move of this entire
I would try
extension.
It there.
Yeah, it's going to be putting us, you know, we're in between fibs here. You know, I don't know. But how do you feel about the sterling up at these levels? I mean, look, Ryan, your economy's heading into, you know, like you guys are like in, you guys are in, what do they call it when you have high inflation and no growth?
Stagflation.
Yeah, you're in stagflation.
Stagnation. Yeah.
You are just in stagflation-orama there in the UK. What do you do? I mean, do you sell the sterling in this case? I mean, what do you do?
No, the break of 130. I had a little crack at the 130 because it wasn't breaking while euro dollar was going. It was just not getting through yesterday afternoon. So I thought, right, I'll dip a little short. I could have put money on getting stopped overnight, which I duly did. But yeah, it's gone through a big psychological level. I'm bang on board with you, and I've got a level at 131.70 as well. If we break that, it's 133, and this is the thing with cable. We can sit again. Yeah, the economy isn't doing too well, and next week we come in and it's 135. That's cable for you. Hence why it's important to look at the crosses, because that gives you the true story. But really, what's happened for the dollar overall is that we've knocked out a second hike for the Fed, even pricing a cut now mid-2024. Peak rates have been drawn down for both the ECB and the BOE. So this is a general shift in global rate expectations now. Everyone was hawkish. Now we're undoing that. What the potential here is, now we run too far the other way. We run too far to the extreme side of Fed dovishness. And then that's when you want to start thinking about picking up cable. If we're starting to price cuts in January 2023, that's when you think, well, hang on a minute, now we're getting a bit silly again. That's when you want to start fading the moves, because Powell and the Fed will not want to let conditions loosen too much and let the market, take away what they've already done. So you've got to look for a pushback from Powell if these moves continue, yields dip, financial conditions loosen, because they'll want to fight that quite strongly.
All right. I think this is, we're in a situation where, financial conditions are really going to loosen. I mean, this is where you get the trickle down effect, right? I mean, equities are, how far away are we off of our all time highs? I mean, Dale, help me do the math here.
10%.
Yes. 7.
5.
7. Okay. Yeah, 7.5% off the highs. I mean, look, if you didn't get shaken out during this this period, you're in which most people did not. I mean, I say most people because if you have your 401k and your IRA, you're not trading it. I mean, so you got people feeling a little bit more wealthy despite higher inflationary pressures. Inflation's coming down. I see it in the mainstream media. I read it in the newspaper. Do people even read newspapers? Anyway, financial conditions are going to loosen a little bit naturally. People are going to be buying that $5,000 couch at Restoration Hardware again, which is absolutely bananas. But anyway, you're right, and that is going to be a headwind that is faced with the Fed. And that's one thing that both Michael Brown, I talked to him the other day, Ryan, your colleague there on the trade-off show that you guys do, and it's something I talked with Chris Weston last night on the trade-off as well. The Fed has a hell of a job getting inflation from this 3% to their mandated 2%. It's like the very end of a long run. And you're winded, right? You're winded. That next ratchet down to get, inflation back below 2% is going to be tough for the Fed, and that's it's going to be tough when you have conditions that are loosening like this.
Tip of the hat to David Hunter, stayed bullish all the way through it.
What's that?
David Hunter, Dave H. Contrarian.
Yeah, what about him?
He's talking 6,000 by October, and then an 80% drop.
Wow. Well, 80%, that's kind of, do you think that's a little ridiculous?
Well, I thought 6,000 was, and still do.
Do you think 80% drops are a little ridiculous? Do you think we're following in the footsteps of the
29?
or Japan and in the 80s? I mean, I don't know. Ryan or Stelios, what are you guys' thoughts on that?
Well, I'm just saying he makes point is, you're right. He does like to make headlines.
Yeah. Ryan, well, it looks like we lost Stelios. And
good.
So that guy, like, he's literally on an island. So Ryan, what do you think about an 80% drop in equities? Do you know what that would look like? Just let's quantify that.
Well, you have to take it to 6,000 first.
I know it doesn't matter. Let's do it from here. Let's just do it from where we're currently at.
2,000, 1,700.
That would take us to 750, 800 on the S&P.
Wow.
I'll be a buyer at 900. I'll put a bid in there.
I'm going to scale in from here.
I literally, I'm scaling in from here.
Yeah, down.
That's what I do, man. That's what I do.
All right. Hey, Ryan, we got a few minutes before the producer prices and weekly unemployment claims. What are you seeing? And I mean, what's your play right here, right now?
Euro dollar, Dale, we're up at near Dale's big level. 1184 is the 200 weekly moving average. Which is going to be very important, I think, how we close this week. We close above or below. So keep an eye on that level. Obviously, we've got big Dale's 112 up here as well. I might have a little sniff at that on a first test for just a big figure scalp, as I want to do. If we go through there, though, it's really the 115 level, and that is an absolute doozy of a level. I mean, that is a 20-year massive level at 115. And if we get through 112, that's where we're at. On the downside, I think you've got to look in towards the break. I've got a little bit of a trend line break across the recent highs. That comes in at 1125-ish. Pretty much.
Are you talking like this?
No, off the tops.
Okay.
Where your black line is there.
Right here? Okay.
Yeah.
So you're doing something that looks like this.
No, your black one you've got there.
Oh, this one. Okay. All right. That one off these highs. Got it. Yep.
Yeah. So that's about 1125. So that's your support area. And dollar yen, what are we going to do down here? Are we going to bust this 138? If we do, we've got another big level down into the low 137s, confluence of the daily moving averages down there as well, fib levels. Everything's going on around the low 137. So
I want to say this dollar yen move has taken me back a little bit. I didn't expect this big of a move, even though I had yen exposure. I was short. I forget exactly what I was short. New Zealand yen, Aussie yen. I had some euro yen and guppy pound yen. Through this move. But man, that dollar yen, I mean, that was like a waterfall event that I didn't see. I didn't think would happen, really.
This is a big deal, I think.
A big
deal.
Yeah, I mean, big deal. So, Ryan, is there any place that you'd be a buyer in dollar yen, or are you just looking to sell it now?
No, I'm happy. I'm happy with my longs off of 138. I'm in at 138.10.
Okay, you're playing it on the long side down here.
Yeah, I'm thinking I maybe cut my shorts here. From yesterday, the short I got in at 139.20s. I might just get out of that and play the long side. But yeah, it's going to be interesting. We're not out the woods at all. We need a move back above 139 in the first instance to take a bit of pressure off. If we can't, we keep the downside pressure in play. But this is the longest period that we've gone without falling over the last few days, and that's an important signal.
That is important. Hey, Abuth asked about the Canadian yen. Look, we're at support zone, pretty key support zone, and at the 50 DMA, and we've been holding it the last couple of days. So keep that in mind. I think the Aussie yen, I was looking for a rally last night. We have rallied pretty significantly. Risk is rallying. So as long as risk continues to rally, you got to be a little careful with the Canadian yen. But then again, now we have crude oil, dipping back down towards $75. So, look at the Kiwi yen, really big rally off of that 50 DMA. Can the Canadian yen follow suit? I actually like the Canadian short, the Canadian currency short, but it could get dragged up with the rest of the other complex. Hey, Dale, how much time we got? Let me see here. We got just about 45 seconds. Yeah, less than a minute. Let me pull up all the stuff for you. So here's the DXY, but we are going to pull up and we should have looked at yields. I didn't get a chance to do that. I know you guys did a little earlier. Here's the dollar index right here. Let me fix this one. Here's the S&P. I'm going to bring this down just a little bit too. There's the S&P right in the middle there. Here's yields, and let me grab the data flash that comes with ForexAnalytix, and the data should be out in a second. So, whoops, in 10 seconds, less than 10 seconds. So here we go, guys and gals. PPI, standby, and initial jobless claims. Let's see how the dollar reacts here.
Soft.
Wow.
2.4% for the core year on year.
And stocks are getting a response. Go ahead. Sorry, Ryan.
Yeah, little softer. So it's pretty much going the same way as CPI. So that should add to what we saw yesterday. But I'm not sure if it's going to be big enough to break current highs, lows that we've seen. But let's have a look.
All right. I'm actually just pulling all of my dollars off right here, just so you guys know. I'm taking all of my dollars off.
Okay, the yen held on that, Brian, so far.
Yeah, I'm taking the rest of my short off in this move.
Yep. Booking profits, guys. I am booking some profits, and I'll reestablish them later. So, yep. Yeah.
Carly here.
Oh, what's that?
We have Carly here.
Oh, all right. Well,
what do you want to wrap it with?
I want to wrap it with good luck, everybody. Thanks everybody for being here. And Dale, I'm going to pass. I want to thank everybody for being here. And Ryan, thanks for the coverage today. I know like a lot of our team is out right now. So just be careful with the dollar. And I think we might see a bit of a reversal here. All right, guys. Thank you very much.
Cover on that on your dollar shorts, Blake.
Thanks. Thank you very much.
You're a pro. And thank you, Ryan, as always. And,
cheers, mate.
Great mentoring today. And Stelios, I do not want to hear your voice for a few days.
There we go.
Okay, so, all right. Thank you, team. Anyway,
thanks, Coach.
Carly Gardner is with us now. Hi, Carly. Welcome back.
Hey, Dale. It's good to be here. Thank you.
Great to have you back, Carly. So, I know that you've been negative the dollar for quite some time. I don't believe that ever changed. I think you're looking for 97. 98.
Yeah, so I've revised it just a little bit. You want me to share my screen and show the, okay.
How many people remember your calls from 3.5 months ago?
Probably none.
That's
how it works. People only remember the bad ones. That's how it generally works.
Oh, see, we all experience that, don't we? All right. Anyway, so take that, haters. Carly's been negative the dollar from the highs. I don't think she ever turned. And you have a 99 number up there.
Yeah. So things, the thing about this stuff is trend lines adjust with time. And so we're looking now, trend line comes in about 99, and that's the way that my chart sees it. Is this is basically the I don't know if you can see the end of this chart. I'm going to scroll over a little bit, but you can see these trend lines date back to like 2017, 2018. So these have been going for a while.
They're like fan lines.
They are.
Right.
Yeah, exactly. And this is like a weekly chart. And so we're coming up against 99 as like a big pivot area. It's kind of the line between bull and bear market. We had Russia not invaded Ukraine. There's a pretty good chance we never would have broken up above and saw this crazy rally and all that kind of stuff.
Yeah.
So the way I'm seeing it is if we break below 199, we're kind of basically going into normalization mode and getting the dollar to a more comfortable level. I think 99 might produce a little bit of a bounce. Your previous host was mentioning something along those lines. And I think that's probably a right take. But I think you can see we're in like this little wedge pattern. The largest bounce I could imagine ever happening is 103, 104, somewhere in there. That would test this trend line, and then I think we go down. Eventually, I think we're working our way to like the mid 90s. I think we'll be seeing that at some point. I mean, it takes time for these things to go, but we're probably talking weeks or months, not days. But I think that's where we're going, is mid 90s. And if the Fed is forced to cut rates, which obviously jury's still out, at some point, if the Fed starts cutting rates, then we're probably talking low 90s, like a complete round trip to from where we started. So it's going to be interesting over the next couple of years. This chart, actually, just as a side note, this chart will be on featured on Mad Money tonight. We're talking about treasuries, and I use this chart to kind of put together a bullish thesis in treasuries. A lower dollar is going to be very supportive for most assets, probably more so treasuries.
Along the world. Why the treasuries, Carly? Why would it be most bullish treasuries?
Because unlike stocks, which have already benefited from a lot of the dollar sell-off, and stocks are kind of at lofty prices, bonds are at probably, like, in other words, stocks are overpriced, but bonds are probably underpriced. So I think the dollar is going to help bonds more than stocks, just simply because of where they are in their cycle.
What's your proxy, TLT, that you're going to be using, or you're going to be showing a yield chart?
We're actually we're actually charting the 10-year note future, just because that's what we trade. We're a futures brokerage, so we kind of stick with that. I will chart the TLT sometimes because it's also a good, like if I'm going really long term, I'll use that sometimes. But this is actually a really nice chart. This is a monthly chart of the 10-year note, and a lot of people are tend to be negative on treasuries because of what the Fed's doing and inflation and all these sorts of things. But those stories are probably at their tail end, not not in their infancy like they were a year or two ago.
How about positioning, Carly? You still have huge, large net short positions by.
We do. Yes. I'll show you that in just a second. So let me get through this chart, and I'm going to show you the COT chart, which is very telling. So you can see we've kind of chopped around here for several months. Some people consider that bearish, but the reality is, look, this is literally what treasuries do. They consolidate for a while and then they make their up move. So this is actually par for the course. The fact that they can't hold rallies is just probably treasuries basing, not anything other than that. And I think, we're probably not going back to the 1.5%. Well, actually, I think we could see 1.5%, believe it or not, on the 10-year yield. I don't think we're going back up to this crazy trend line up here where it took a lot of government stimulus and all kinds of manipulation. I don't think we're going to see that. We could easily see 10-year note at 2%, maybe even 1.5%. Somewhere in there is where we're targeting. Again, takes time. It's probably not going to happen tomorrow, but this is what we're looking for. And in addition to just simply the bullish chart, why we think this might happen. Hopefully, can you see the COT chart here?
I see the T-note chart.
Okay, perfect. All right. So
underneath it, I see.
Yeah, so right down here is the Commitment of Traders data. Commitment of Traders is a report that the CFTC, Commodity Futures Trading Commission, puts out every week. It's a government report. It's disorganized, but you know what? The information is pretty good usually. So we use it a lot. We look at it every week and just kind of look. What we use it for is to identify markets that are maybe overcrowded trades or overheated. And what we've seen in the 10-year note is this green line is large speculators. So that's people that are speculating, not hedging. Or it's possible they're hedging, but they're not doing it officially, reporting that hedge. Anyway, it's mostly speculators. It's mostly people that are trading really big positions. And so these are considered to be the smart money. The thing about the smart money is they're usually smart until they're not. And when you start seeing these people get really long or really short, it's kind of a red flag. This is the largest net short position in the history of 10-year note futures. And we've been catching a lot of flack on this on social media. People are pointing out that the market.
Good sign.
Yeah, exactly. People it's ruffling some feathers. People are pointing out that the markets are bigger. So of course the net short's going to be bigger. But the thing is, it's a net number. It's not a gross number. So they're taking shorts minus longs. Also, yeah, the market's bigger, but this is by far the largest net short position ever. The second largest was here, and that was about 680,000 net shorts. And right now we're well, we're at about 780,000 net shorts.
Is the blue line the commercials and the red retail small specs?
The blue line is small specs and the red line is commercials. Yeah.
They're
and
real
so
long.
They are, yeah. And so at some point, and see, they were same in 2018 when we bottomed. There was a really big spread between those two types of traders, and you see that now.
Yeah.
And reversion to the mean tells us that's going to unwind itself, and when it does, we're probably looking at much higher 10-year note, maybe 124, 125, like the chart that we were just looking at suggests. So
okay, real nice look. So you were talking about crowded trades.
Mm-hmm.
So you know what I'm thinking.
Probably.
What's the most crowded trade out there right now, besides bonds?
Well, besides bonds,
long equities.
I don't know if that's getting that crowded, but it's the. Well, see, I'm only looking at futures, so it's a little bit different. But let's just take a look here. Whoops.
Maybe that's why it keeps going. It's not crowded.
Right. Well, the thing was,
not. I've seen things like greedometers at extreme greed and call indicators, but it still looks pretty good, huh?
Well, okay, so a few months ago, we went out on the various news outlets warning people that there was the largest net short position in the history of E-mini S&P futures, and people laughed at us. So we got hate mail, but the reality is that position has unwound itself. About half of it's been unwound. You can see that's what this little bump is right here. So speculators are actually still net short. It's not as extreme as it used to be, so it's not going to be the tailwind that it was over the last couple of months. But I don't think we're definitely not net long now. If we're talking about like mom and pop investors and that sort of thing, retail investors on the stock side, that could be a completely different picture. So I don't know. Unfortunately, we don't have this kind of information for stocks, so it's more of a guessing game, and we're looking at sentiment indicators. But I agree, the sentiments, people are starting to get a little too complacent. We've got our target in the S&P is about 45.50. Let me see if I can find that chart.
We're almost there.
Yep, we are not too far off.
Yeah, 45, 45.50. Okay. All right. So I know last time you were looking at gold as well, and you liked it, and it grinded for a while lower.
Right.
All right, what are we looking at here?
Well, I was trying to find a good S&P chart, but I didn't.
A good one.
Yeah, this one's pretty good. I did have a better one, but this is good. This is the daily chart. And so this is basically what we're looking at. We've been looking for the short squeeze to play out, and we think that it has mostly played out. So with that in mind, we've got trend line coming in here right around 45.50, and seasonality is still bullish for the next handful of weeks. So you want to be careful. Sometimes with summer markets, the volume's light, it's thin, and it just grinds higher because the only people participating in the markets are active traders who are usually net short. And so it ends up being a short squeeze environment. But that said, we turned bearish at 45.50 and would like to see what happens. I'd say pretty good shot at a nice correction. I'm not bearish. I don't think the world's ending, but we could easily see 4,300, 4,200. Yeah.
Yeah, that was a breakout. Yeah.
Yep.
Okay. And energy wise or precious metal wise?
Okay, so let's take a look at gold real quick. I'm still bullish gold, but the thing about this market is it spends almost all of its time trading sideways, and then it makes its move all at once. And so it's really, really tough for active traders. It's just a weird market. This is what I've got in gold. And to be honest, I thought we were going to sell off a little more. I was looking for like the mid to high 1800s as a place to really get aggressively bullish gold, and it just didn't happen. So we'll see how it goes. Honestly, this kind of stuff, things change fast. It's not impossible that we still go down and test that. So if you're flat and you're waiting for a place to get in, you want to be conservative, maybe consider something in that ballpark, 1860, 1875, somewhere in there as a place to put on your radar. Ultimately, I think
where's that red moving average coming in underneath the trend line? Is that a moving average?
This one here?
No, above it. No, it
this orange
must
one?
be a moving average, right?
This orange, yeah, this one right here. Okay, that's the 200-week moving average. So yes, and it would have buyer. That would be a great place to be a buyer. I would love to see that. I was hoping for that. Didn't happen. It might happen.
Well, maybe we have to rally to 2000, 1980 first, and then if you get your 99 low in the dollar. So just I'm putting your narrative together for you.
There you go. That's a good one. You're right. But generally speaking, just as a rule of thumb, anytime the market touches a 200-week moving average, never any guarantees in this game, but that's pretty good. That's pretty close. Very rarely will, I mean, the 200-week moving average is a place that if you're a value buyer trying to buy a dip, that's just a place that makes a lot of sense and it works out more than it doesn't.
Nat gas still a value, isn't it? And maybe it turned the corner.
It is. It seems like maybe this is nat gas. I'm constructive in nat gas, but we're probably going to at least retest this trend line. So we probably have this is right now we're trading about 260 on the front month. Could see 245, 250. And honestly, the way nat gas is, I wouldn't be super shocked to see 210 just to basically ruin a few lives before it does it.
You know, so there are more widows that collect on
exactly
life insurance.
100%. That's what it does. So you have to be really here. I'd be a nibbler. Here I'd be pretty aggressive. That's how I would look at it. But all in all, I think yes, it's a long-term buy.
Okay, and I know you follow ags, and
I do.
You know, we have Grand El Nino out there. We had a pretty good rally in beans, and wheat's still putting in a higher low, but corn has been the dog.
Corn has been, so we got
trying it here.
We are just nibbles. I wouldn't. Here's the thing. This time of year, grain rallies can be magnificent because there are weather concerns and people panic, but they almost always fail. And so you want to be really, really careful. And this time of year, even with corn in the hole like it is, fundamentals are actually pretty supportive for corn, but sometimes that doesn't matter in the short run. I worry that if we close below 480, this is December corn, by the way, this is new crop corn. Right. If we close below 480, there's just this big gap, and speculators are still net long even after the sell-off. So I worry that we get, like, if it continues to rain, you know, rain makes grain and people just sell without even asking questions. That's how people have been trained.
I was a young man, they used to buy rain breaks. In a bull market in grains, you buy the rain.
You would think so. You know, I don't know if it's the algos or what, but it's
that's
literally
prehistoric times, Carly. That probably doesn't work anymore.
So
no one's at the board of trade anyway.
That's true. Nobody's there, so they have to actually check the weather reports. So what we're doing is just buying 550 calls. They're really cheap. You can get them for less than $1,000. I think last I looked was like $600-700, and it's just that'll give you 100 and something days in the market with low risk, limited risk, and we can see what happens. I'd be willing to get more aggressive if we drop to 450. 450 would be extremely cheap for corn. If it happens, it happens. I mean, you can see we're holding the trend line here, so there's probably a 65-75% chance it holds and rallies, but I wouldn't be willing to jump in with anything.
Wouldn't it be a better shot buying a market making higher lows like beans or wheat on weakness rather than bottom picking?
Well, here's November soybeans. I don't have this. Isn't the best chart. We actually have some trades on in beans. We're bearish beans. And mostly because of seasonals. So like
1250 you're looking for.
Maybe? Yeah, so I would say this on November, I would say anything around 14 is a place to be a bear. We're looking for, you're right, about 1250. Maybe if things get real crazy, 1150. But again, just simply because this time of year, it's really, I haven't seen very many people make money buying and holding grains this time of year. It's usually just a sell the rallies kind of thing. You might take some heat early on, but eventually it works out. And so that's how we're looking at it.
Okay. Anything, I think we've covered a lot of the board. My takeaways, really pay attention to yields and notes. Pay attention to the Dixie, maybe around 99. Okay, here's some.
I'll
I
throw
pay a
this
lot
out
for
here.
steaks now. Go ahead.
I know it's insane. Cattle. I'm just going to throw this out here. Maybe nobody trades cattle whatsoever, but this is a trade we put out yesterday.
You know, I was a runner on the CME floor in the mid 70s. I just cannot believe these prices.
It's wild. The demand just doesn't. Price isn't deterring demand, but I think eventually it will. And the seasonal top in cattle is like late July. So I think anybody that's got upside exposure here is probably just pressing their luck at this point. We put on risk reversals yesterday. We recommended to sell 195 calls in December and then buy the 175 puts. I mean, for educational purposes, I'm offering this, not to tell you to go do that. It's not for everyone. This is mostly if like we have a lot of cattle ranchers and this is a wonderful way for them to hedge their price risk because it's free insurance. Yeah. So they like the money we collect for the call pays for the put and they get free insurance. Right. And then that way they can just see what happens and they still get to make money from 182, which is right. They get another 10, 12 points out of it. But they have risk control in place. Anyway, cattle has only behaved this way one other time in history, and it was like 2014, 2015. And when it, in those years, had this miraculous rally, just like we're seeing now. And then once it rolled over and died, it literally died for a decade. Like we're just now getting back up to those prices that we were in 2014. So I have a feeling we're kind of repeating something like that, but it's hard to pick highs. You just never know how high is too high. Eventually it hits. And after the fact, it's easy to point out, but before the fact, you don't know. But I think chart wise, fundamental wise, and seasonal wise, everything's lining up for this to be a potential place for cattle to roll over.
Okay. Well, you know, people that watch this video later, people that are watching it now, I'm very, impressed with Carly's knowledge of not just being a technician, but her knowledge of the fundies and the way she follows commitment of traders reports and, her strategies of how she's tactical. So best way for people to follow you and stay in touch with your work, Carly, would be?
You can visit our website, decarlytrading.com. You can sign up for a free newsletter trial. There's a tab over here on the side that will allow you to do that. And you can kind of follow along and see some of the things we're doing. If you're on social media, which I suspect you are if you're here, we're on Twitter. The handle is @CarlyGarner.
Okay. And really, how many commodity people or futures people know how to trade and also how to set up a hedge for producers using options? So that speaks for itself, Carly.
Thank you.
It's always great to get some real elite views from you.
I appreciate it.
Much respect. I'm a fan.
Well, thanks, Dale. I appreciate it.
All right, Carly Gardner, everybody, check her out. I'm introducing her to you for what? How many times have we done this now, Carly?
I've lost count, but it's been several, so it's been a good time. Yeah.
All right, let's keep it going and have a great summer trading season.
Thank you. You too.
I'll be in touch with you, Carly. Thank you. Yep. All right, so that's a wrap, everyone. And you can join the team in 17 minutes. Okay, you're welcome, Patrick, Jean-Francois. See you guys. You're welcome, Rick. Don't just count your pips, count your blessings. I know you probably get tired of hearing me say it, but force yourself. Adios.